and I have Ladi Belo as a fixed income trader at Access Bank. He joins me now for more on the markets today. Thank you for your time today, Ladi, and let's first start with your assessment of the markets today.
Hi, Kenneth. Thank you for having me. Just like you said, we had a bit of interest stemming from the bond auction that was conducted by the DMO on Monday. We saw a total of 225 billion being offered across the standard tenors. That's the 2029, the 32s, and then the 2037 reopening. As you said rightfully, we've seen quite a bit of demand stemming from the bit of shock that we saw at the last auction, where we saw the 32s being the most, having the most significant drop in yields, and also the 37s. The 37s continue to be the most highly demanded paper, given the yield attributed to this instrument and also the duration on the bond. But having said that, we've had a fairly healthy and active market within the bond space, and this is despite the fairly thin levels of liquidity. But given the limited investment outlets that local investors have, we've continued to see a bit of rally in that space, and that has continued into today's trading session.
Yeah, but how are you weighing the opportunity in the secondary bond markets then?
Please repeat that.
How are you weighing the opportunity you're seeing in the secondary bond market?
Well, when you compare the yields, well, the yield differential, there's a bit of a disparity there. So the auction on the 2037 closed at about 15.8% levels. Now it's currently trading just above the 15% mark, which represents an 80 basis point spread just before the settlement of this auction. So there is a bit of arbitrage, and the arbitrage is even more when you look at the shorter tenured instruments. That's the 29s and the 32s, which are the on-the-run bonds, where we're seeing a bit more of a yield movement or a differential in yield between the primary and the secondary market to the tune of about 150 basis points.
And now, for the Treasury bills auction today, what can we expect then?
Well, the amount on offer this time around is quite small. We have about 13 billion being on offer. And the similar trend last week as well, where we saw a fairly small amount on offer on these standard buckets as well. Last time we saw the yields drop on the one-year paper by very close to 180 basis points on the 364-day paper, coming from the 14.84% levels, and it closed about 13.05%. But going into today, we do expect to see more of a yield drop to the sub 11% levels on the one-year maturity, which is where we're seeing the most interest across the NTB curve. The market has been fairly quiet, as attention has been generally shifted to the primary market auctions. Again, we're seeing a bit of a disparity, like I mentioned, between the primary and secondary markets. So the disparity in terms of yields now is about 200 basis points, which represents some arbitrage for some of the investors within this space.
Yeah, because we've had quite a run in the market this year, but I'm trying to imagine what your outlook is for the fixed income markets in the first quarter next year. Quite a lot to consider. Okay,
from the looks of things, we've seen that the market has gotten to a high of about 16.2 or 16.25%, and this is specifically on the 37s. For obvious reasons, it's reopening, as well as the fact that it has a fairly, the tenor is on the midpoint, is on the belly of the curve. So we've seen the yields peak a little bit, I would say, especially when you look at the global outlook. When you see the CBN in terms of tightening its policies, I think the body language of the CBN shows a bit of ease up. And when we're looking globally, global inflation seems to be showing a little bit of moderation as well. Also, the Feds, the hawkish stance of the Feds seem to have moderated a bit. So globally, we seem like we're reaching the peak in terms of yields, but the only factor holding this back would be the war or the crisis between Russia and Ukraine. But by and large, in this part of the world, we've seen yields reach the all-time high of the 15.25% levels, and I don't think that we'll continue to see these levels being sustained in the markets going into Q1, despite the elections being conducted in February. So I see a bit of moderation again. The on-the-run bonds will continue to be the most actively traded. The liquidity will keep being supplied into the system by the DMO and the CBN respectively, and we expect yields continue to gradually to trend downwards as we approach Q1.